Hey guys, Tom here from the Investing with Tom YouTube channel. It's still a sunny Sunday morning here in New Zealand. I'm going to record a second video today. You may not be seeing this until later in the week, but let's get into it. So today I'm going to talk about a concept called margin of safety, and Ben Graham described those three words as the most important three words you will ever hear in investing. So let's get into it and let's talk about what margin of safety actually means. So before we do that, love to see you subscribe, drop a comment, give me a like, and let me know some ideas for future videos or things you'd like me to talk about. So let's get into it. Alright, so a bit of background on why we're going to talk about margin of safety. It's something I see with a lot of the popular YouTube channels out there in terms of stock market investing. A lot of them are very focused on upside. How much money can you make? How quickly can you turn $1 into $2 into $10? And they really tend to ignore downside a lot of times. So there's some great YouTube channels out there that definitely do focus on margin of safety, like we're going to talk about, and limiting downside. But a lot of investors are focused on really high growth companies and trying to get rich tomorrow. That's not something that's really all that realistic. So today I wanted to talk about why it's important to consider downside and what kind of effects that limiting downside can actually have on your returns in the long term, because it is pretty significant. All right, so why is it important to limit downside? I think this is probably best explained by just running through some basic numbers with you. So let's say you have $1,000 to invest and you put that into ABC company because you think that company is going to be far more valuable in the future than it is today. That's fantastic. But let's say you actually turned out to be wrong on your analysis there. Something went wrong with the company and the share price actually went down, say 50%. So you invested $10,000, it's now worth only $5,000. So a lot of people, when they think of that investment, on the face of things, they'd say, okay, I've lost 50%, I need to find an investment that's now going to return me 50% and I'm going to be back at where I started. If anyone knows basic maths, they'll know that that's not true. So if you have $10,000, it cuts in half, goes down to $5,000. To get back up to $10,000, you actually need to double that money. So you need to go out and find an investment that goes up by 100%. And that's not an easy thing to find, especially not one with a low amount of risk. So, you know, protecting downside is very important. It can have a huge impact on how much money you end up with at the end of the day. So it's very important to protect your downside. So let's get into talking about how you go about that with a concept called margin of safety. All right, so what is margin of safety? Essentially, as value investors, what we're going out there and doing is assessing the value of a thing. That thing may be shares in ABC company that's publicly traded. It may be the value of a house. It may be the value of a bond or some other sort of cash producing asset, and it may be the value of an option, we don't know, but for the most part we're going to be talking about probably shares in this example. So what a value investor does is they figure out what they think is the value of a thing. In this case, let's assume we're buying shares in, say, Apple Computer, and we want to buy shares in that company for less than what they're worth. And the degree to which we're able to do that, so let's say we think Apple is worth $200, not that I do think it's worth that or anything, entertainment purposes only here, but let's say we think Apple is worth $200 a share. We want to buy that for much less than $200 a share. And the more, the further we can get below that $200 mark, the larger our margin of safety. So the margin of safety is sort of that gap between the value of the business and the price that we pay. So in value investing, we definitely don't believe that price and value are the same thing. We want to find something that has a high value and a low price. So when we do that, that is very effective and very powerful at limiting our downside. So if something's worth $200 and we buy it for 100, if it goes down to 50, great news, let's buy some more. We've just got a larger margin of safety, and once the market does sort of come to its senses and value those shares of Apple fairly at $200, assuming we are correct in our valuation, we're going to make a massive return from that. If it continues to go down to 40 or 30, that's a monstrous margin of safety that the market has given us for whatever reason. Maybe we're in a recession, maybe some very bad news came out about Apple, maybe the market's just been emotional and scared. And it's the value investor's job to take advantage of those opportunities and provide yourself with a margin of safety to generate some pretty massive returns. So an investor that I follow really closely by the name of Mohnish Pabrai, he's a guy that's compounded money at 25 to 30% plus even, I think, for well over a couple of decades now. So he actually has compound 26 on his number plate on his car, which is very cool. If you compound money at 26% of the year, fun fact, you'll triple your money every 3 years, and that's Mohnish's target. So one of the things that he says about this style of investing, he calls it buying a free lottery ticket. And you know, I'm not a lotto ticket buyer. I think that's gambling at the end of the day. But if you're getting lotto tickets for free, there's no risk in that, or there's very, very low risk if you're taking this approach in the stock market. So that's what margin of safety is all about. It's about buying free lottery tickets. It's about finding $10 notes and buying them for $5. If you go ahead and do that, there's not a whole lot of risk there and not a whole lot of downside potential. So that's my thoughts on margin of safety. I hope you got a lot out of that video. If you have any questions or anything, feel free to drop me a comment. Love to see you subscribe and give me a like on the video too if you did enjoy it. And I will see you next time. Cheers.